Look, if you're watching this right now, it's probably because something in your gut is telling you that things aren't quite right in the financial world. And honestly, I've been feeling the exact same way because when you see gold sitting at $4,800 an ounce here in January 2026, your first instinct might be to think you've already missed the opportunity, that the ship has sailed without you. But here's what I need you to understand before you click away. The biggest financial institutions on the planet, the ones managing trillions of dollars for the wealthiest families in the world, they're quietly telling their private clients something very different from what you're hearing on the evening news. They're saying the real move hasn't even begun yet. And I'm going to prove that to you with actual data in the next few minutes. Now, I'm not here to sell you anything or pump up some investment scheme. I'm here to lay out 3 undeniable triggers that are happening right now in 2026 that make owning at least some gold not just a smart diversification play, but potentially a mathematical necessity if you want to protect what you've worked your entire life to build. So let me ask you something real quick. When was the last time you actually looked at the numbers behind the US dollar? Like, really looked at them? Because what I'm about to show you isn't conspiracy theory stuff. This is straight from government data and major bank research reports that anyone can verify. Trigger number 1 is what I call the silent exit from the US dollar, and it's happening faster than most people realize. For our entire lives, we've been told that cash is king, that the US dollar is the safest place to park your money, but as we're sitting here in early 2026, the US national debt has exploded past $38 trillion. I need you to understand that this isn't just a big number that politicians argue about. This is a number so astronomically large that it literally breaks the human brain's ability to comprehend it. But here's the part that should genuinely concern you. The rest of the world has started backing away from buying our debt. And when I say that, I mean it's measurable and it's accelerating. In the first quarter of 2025, the US dollar's share of global currency reserves dropped to roughly 58%, which is the lowest level we've seen in almost 3 decades. And you might be thinking, okay, so what does that actually mean for me and my savings account? Well, let me connect the dots for you. When countries like China and India and even some of our traditional allies stop buying US Treasury bonds, the Federal Reserve is left with basically one option. They have to print more dollars to buy the debt themselves. And that's exactly what's been happening. We are witnessing what economists call a debasement trade playing out in real time, which is just a fancy way of saying that the value of each dollar in your wallet is being quietly eroded because there are more and more dollars being created out of thin air. Now, here's where it gets really interesting. Goldman Sachs, one of the most powerful investment banks on earth, just released a report this week and they raised their year-end 2026 gold price target to $5,400 per ounce. Let that sink in for a second. They're saying gold could go from $4,800 right now to $5,400 by the end of this year. When you dig into their reasoning, they explicitly cite private sector diversification as the main driver. What does that mean in plain English? It means the ultra-wealthy, the people with access to the best financial advisors and the most sophisticated market intelligence, they are terrified of holding too many dollars, and they are systematically moving their wealth into physical assets like gold. If the smartest money in the room, the people who literally have teams of experts analyzing every tick of the market, if they're betting heavily that the dollar is going to lose purchasing power, why on earth would you keep 100% of your life savings denominated in that same dollar? That's the question I keep coming back to. Now, let me hit you with trigger number 2, and this one is absolutely wild when you look at the scale of it. I call this one the whales are hungry, and by whales, I mean the central banks of the world. You and I, we're retail investors. We might buy an ounce of gold here, maybe a couple of coins there if we're being responsible about diversification, but central banks are buying gold at a pace that we have not witnessed since the end of the Second World War. According to data from the World Gold Council combined with recent analysis from J.P. Morgan, central banks are purchasing an average of 60 tons of gold every single month as we head deeper into 2026. Stop and think about what that means. These are the same institutions that print fiat currency. They know better than anyone else on the planet what's coming down the pipeline with interest rates, inflation, currency devaluation, all of it. And if they genuinely believed that their own paper currencies were safe and stable stores of value, they wouldn't be trading them for gold bars at record-breaking speeds. trades, would they? The logic is inescapable. What's even more fascinating is when you break down which countries are doing the buying. It's overwhelmingly emerging market nations, countries that remember what it's like to have their currencies collapse. They are aggressively selling their dollar reserves and converting them into physical gold because they are building a financial firewall. They are preparing for a world where the US dollar is no longer the undisputed king of global reserve currencies. When the biggest, most informed players in the entire global financial game are accumulating an asset at historic rates, that's not just a signal to pay attention to, that's a blaring siren telling you that something fundamental is shifting beneath the surface. And here's what really gets me. The mainstream financial media barely talks about this. You'll see a tiny headline buried somewhere, but nobody's connecting these dots for regular people. Now let's talk about trigger number 3, and honestly, this one is probably the easiest to understand because you can see it playing out on the news every single day. I'm talking about the geopolitical powder keg that we're all sitting on right now. We entered 2026 carrying all the baggage from 2025. We've got trade tariffs that are disrupting global supply chains and making everything more expensive. We've got active conflicts happening in multiple regions of the world that unfortunately have started to feel normal. And we've got political tensions between major powers that are higher than they've been in decades. Here's the thing about gold that a lot of people don't fully appreciate. Gold absolutely thrives on fear and uncertainty. It is the ultimate hedge against chaos, because when people lose faith in governments and currencies and the normal financial system, they turn to the one asset that has held value for literally thousands of years of human civilization. Global Data, which is a major market intelligence firm, just revised their gold forecast, and they're now suggesting that gold could test levels significantly above $5,000 per ounce if these geopolitical tensions continue to widen. And when I look around the world today, does it look more stable to you than it did 5 years ago? I don't think anyone could honestly answer yes to that question. On top of all the geopolitical stuff, we're also looking at the Federal Reserve likely cutting interest rates by another 50 basis points sometime this year. And if you understand the historical relationship between interest rates and gold prices, you know exactly what that means. When rates go down, the opportunity cost of holding gold decreases, and simultaneously, rate cuts typically weaken the dollar, which makes dollar-denominated assets more attractive. We are looking at what I would call a perfect storm scenario. Let me get real with you for a second here, because I think this is where the rubber meets the road. $4,800 gold might feel expensive to you today. It might feel like you missed the boat, but I can guarantee you that people were saying the exact same thing when gold hit $2,000 back in 2023, and they were definitely saying it when gold crossed $1,200 back in 2018. The people who waited for a dip in 2024 are still waiting, and while they've been waiting, the purchasing power of their cash savings has been quietly evaporating month after month due to inflation. Now, I'm not standing here telling you to sell your house and put everything into gold. That would be absolutely reckless and irresponsible. But if you currently have zero exposure to gold, if your entire portfolio is 100% stocks and cash, then I would argue you're basically driving a car at highway speed without wearing a seatbelt. You might be fine, but if something goes wrong, you have zero protection. The $4,800 gold price target isn't really about trying to make a quick profit. It's fundamentally about wealth preservation. It's about making sure that the money you've saved actually maintains its real-world purchasing power when everything else is being inflated away. When Goldman Sachs puts out a $5,400 target, they're not just guessing. They are running sophisticated models that calculate the rate of currency debasement, and their math is telling them that gold needs to be significantly higher just to reflect the current monetary reality. So here's what I need you to do after you finish watching this video. I need you to take an honest look at your portfolio and ask yourself this simple question. If the US dollar loses another 10% of its purchasing power over the next 12 months, which a lot of economists think is entirely possible given the current trajectory, am I protected against that? Do I have any assets that would actually benefit from dollar weakness? If your honest answer is no, then you've got some homework to do. And I don't mean that in a condescending
condescending way, I mean that genuinely because I've watched too many good people work their entire lives only to see their retirement savings get crushed by inflation they never saw coming. Do your own research. Go read the actual reports from JP Morgan and Goldman Sachs. Look at the central bank gold buying data from the World Gold Council. It's all publicly available. But please do not just stick your head in the sand and pretend that everything is fine. The window to establish a position before the next major leg up toward $5,000 and beyond is closing. The institutional money has already positioned themselves. The central banks have already positioned themselves. The ultra-wealthy families have already positioned themselves. The only question that remains is, are you positioned, or are you going to be one of the people looking back 6 months from now, wishing you had paid attention to what was happening right in front of your eyes? I genuinely hope this video has given you something valuable to think about and motivated you to at least investigate your options, because knowledge is power, and the more you understand about how this game is actually being played, the better decisions you can make to protect yourself and your family.